Everyone chasing double-digit yields right now is making a bet they do not fully understand. Not a calculated risk with known parameters. A bet where the downside is invisible until the rate environment that was suppressing it changes. And in 2026, that environment is changing in a direction that is going to make the difference between a high-yield position and a dividend growth position the most consequential portfolio decision of the decade. The investors who understand why that is true before the repricing is complete will look back on this moment as one of the clearest opportunities they ever had. The investors who stay in the high-yield trade because the income feels reliable will understand what was happening long after the opportunity to act on it has closed. Let me start with the mechanism that most yield-chasing investors have never fully traced through to its conclusion. A high-yield stock, one paying 8, 10, 12%, is paying that yield because the market has priced the share down to a level where the fixed or slowly growing dividend payment represents that percentage of the current price. The income is real, the check arrives, but the yield is high for a reason that the check does not explain, and the quarterly statement does not show. The share price that makes the yield look attractive is a share price the market has discounted. To reflect one or more of the following realities, the dividend is not growing or the payout ratio leaves minimal buffer. For reinvestment or unexpected cash flow pressure, or the underlying business is in a sector that the rate environment is disadvantaging, or the income is being funded by mechanisms that are finite rather than operational, any one of these factors alone creates a ceiling on what the investment can produce over a full market cycle. All of them together create a position that is failing to build compounding wealth. The 2026 interest rate pivot is the specific catalyst that is making this distinction urgent rather than merely theoretical. Here is what the rate pivot does to the relative performance of high-yield versus dividend growth stocks, and why the mechanism works in a direction that is counterintuitive. When rates were near zero, high-yield stocks were bid up aggressively because income-hungry investors had no alternative. The premium they paid compressed the total return potential of high-yield positions. As rates rose through 2022 and 2023, the capital that had bid up high-yield positions rotated into fixed income alternatives. That offered competitive yields with dramatically less complexity and volatility. High-yield stock prices fell. Their yields rose, not because the businesses were paying more, but because the prices were lower. The investors who stayed saw the yield number on their screen increase while the value of their position was declining. Now the pivot. As the rate environment begins shifting in the direction that 2026 is beginning to show, not dramatically but directionally. The fixed income alternative that pulled capital away from high-yield equity becomes less attractive on a relative basis. Capital looks for the next destination, and here's the critical insight that most investors miss in this rotation. The destination is not back to the same high-yield positions that capital left. It is the category that combines income with growth. Dividend growth stocks whose total return will compound from both the income stream and the multiple expansion that follows. When quality businesses with growing dividends become the preferred destination for institutional income capital, the payout ratio is the number that separates these two categories more reliably than any other metric. A high-yield stock with a payout ratio above 85% is not just paying a large percentage of earnings. It is constraining its own ability to invest in the business and to fund growth. When the environment shifts, the company with an 85% payout ratio has almost no financial flexibility. It has committed the vast majority of its cash generation to the dividend payment, leaving no room for error. Any reduction in cash generation moves the payout ratio above 100% and forces a decision. The board either cuts the dividend or funds it through debt or asset sales. In a rising rate environment, debt is expensive. In a stressed business environment, assets sell at discounts. The outcomes available are uniformly bad for the income investor. A dividend growth company with a payout ratio of 40 to 60% is in a structurally different position. The retained earnings not paid out are available to invest in the business and strengthen the balance sheet, to repurchase shares at attractive prices, and to increase the dividend at a rate that compounds the income stream over time. When cash flow comes under pressure, the dividend growth company has room to absorb it without cutting the payment, because the payout ratio started well below the ceiling. And when the business environment improves, the retained investment generates growth. The total return math over a 10-year period demonstrates why this distinction matters at the portfolio level. A high-yield position paying 10% with zero growth on a $100,000 investment generates $10,000 in year 1. $10,000 in year 10 and $10,000 in every year between if the share price holds flat. If the share price declines by 30%, the historical median for these positions, the total return is $70,000 of principal. A dividend growth position paying 4% initially and growing at 10% annually on the same initial investment generates $4,000 in year 1 but $10,372 in year 10. Having matched the high-yield position's absolute income by year 10, despite starting at less than half the yield. By year 15, the dividend growth position's annual income exceeds the high-yield position's flat income permanently. But the comparison is more dramatic because the growth also drove the earnings that justified multiple expansion in the share price. The share price reflects that growth. The total return is not just income. It is income plus capital appreciation. The 2026 interest rate pivot is accelerating this divergence because it is pressuring specific balance sheet vulnerabilities. The refinancing risk, the constrained payout flexibility, the absence of retained earnings for capital investment, while creating the tailwind that dividend growth positions are best positioned to capture. Quality businesses are not just avoiding the downside. They are generating the earnings growth that will fund the next decade of dividend increases from a position of strength. The rotation from high yield to dividend growth is not a prediction. It is a pattern that has repeated across every major rate cycle and is repeating again in 2026 for the same structural reasons it always has. The investors who are positioned ahead of it are not speculating. They are following the math to its logical conclusion before the rest of the market arrives at the same destination. And the premium they are paying now becomes the discount they are collecting later.